Good morning, everybody. Welcome to the Flow Show, Tuesday, 14th of May. All ready to, try and wake up from these sleepy markets at the moment and see if we can get some trades going, make some pips at these quiet times right now. A few things coming up today. Obviously, we've got POW and the PPI data. So we've had a few bits and pieces out since then, or before then, rather, and since last night. So we'll go over what has happened and pick the bones out of it. Over in China, the China Securities Journal reports that China may cut the RRR rate, the reserve requirement ratio rate, when this bond issuance has finished. As mentioned yesterday, China going to be undertaking selling some bonds to raise money for infrastructure spending and various projects to get the economy back on track. And when that's done, they may help it along by cutting that RRR rate, which if they do should see a little bit of a boost to the Aussie dollar. If and when it happens, we'll get a headline, and you usually see a pop in the Aussie dollar when that happens. So we'll keep an eye out for that one. Over in Japan, we've had a bit of data out from there as well. PPI numbers coming in as expected, 0.9% year on year, as expected, and as per prior, though that prior number was revised up as well. So still some inflationary input from there. Month on month PPI coming in as expected at 0.3% as well. What hasn't been good news is the preliminary numbers for machine tool orders, which fell 11.6% year on year. So that's not good numbers at all. Those are April numbers there. It shows a bit of weakness still in the manufacturing and the production sector for Japan. Finance Minister Suzuki has been speaking, as he often wants to do each day, talking about cooperation with the government and the BOJ, saying that the bank and government have been working together to end deflation, that it's important for the BOJ and government to communicate closely. It says important that FX moves stably and reflect fundamentals. Also said he's aware that Ueda has said he's watching FX moves too. Then he gave us a bit of a, well, one could call it a bit of a strange comment. He says they're watching JGB yields developments closely as well, and they're watching yields and will respond as necessary. So a bit of a nod there to yields. Are they going to intervene in the bond markets as well, which Bank of Japan's doing that for them already, but there's been a lot made of the yield moves of late. In fact, they've been reaching new highs in some of them, so they don't want or won't want yields. It's going to a bigger chart. They won't want yields to be running too hot too fast, because that'll put a lot of pressure on obviously government financing. So that's something that I may look to the Bank of Japan just to keep the brakes on as well, not to let things run too far the wrong way for them, even though Japan's in a hiking cycle, supposedly, so high yields is a natural effect of that, but it's all about how fast and how high they allow them to go. Over at the SNB in Switzerland, SNB Jordan says the fight against inflation is far advanced, and that the Swiss inflation outlook is now much better, which may be seen as maybe keeping the door open for another cut to come if inflation's going the right way. No direct comments on FX that I could see from him, so that one's off the agenda at the moment, shall we say, but likely be back in at the next SNB meeting, which will be in June. Over in Germany, we've had some data out. Zoo numbers out this morning showed a bit more of an improvement. Overall economic sentiment rose to 47.1, better than expected. Was expected to rise to 44.9, up 2 pips over April. Current conditions still deeply negative, but not as crappy as they were. Better improvement to minus 72.3. So maybe some green shoots still poking their heads above the ground. Over at the EU, Commissioner Gentiloni says the acceleration of euro area activity is taking place. However, geopolitics are weighing on the overall outlook for the euro area. So he's seen some green shoots there as well. We did get a bit of, we've had some more final numbers out, CPI numbers and whatnot, all largely unchanged. Spain, no change there over the final numbers for CPI or HICP. Same for Germany, no real change there either. And I think Spain was out yesterday and them showing pretty much the same thing. Oh, sorry, they were Spain, showing the same thing. So those final numbers not really changing the picture of what we already knew. Spain CPI going up, Germany CPI looking a little bit sticky as well, staying around the same levels. Over in the UK, we had the jobs data out, which, well, it depends how you look at it. It's some of it's been picked out as going the same way as in favours the Bank of England cutting rates, but I've got a slightly different slant on it. So overall, the jobs market, we saw a rise in claims, not as high as expected, 8.9k. The 3-month rolling employment change was down 177,000, not as much as expected, down 215,000, but still a negative number there. However, we saw the unemployment rate rising to 4.3% as expected, so it did go up a pip. But those wage numbers still very sticky. Average earnings, including bonus, came in at 5.7%, was expected to fall to 5.3%, and last month got revised higher as well, hence why that number's green. So still sticky inflation pressures there from wages. Take off bonuses and wages rose 6%, matching last month's 6%, were expected to fall to 5.9%. So the wage numbers are still proving very sticky, and seeing as it's inflation that's the bank's main mandate, they can overlook the weaker, very slightly weaker employment numbers, but those wage numbers will be the main concern for them. Now, what is to kick in is these numbers are for March on the wages front. Next month, we will get, or should see, the impact from the minimum wage rise that kicked in 1st of April. So we won't get that until the next jobs report, which for the majority of workers raised wages by 9.8%, but some of the other age groups, like 18 to 21s, they went up over 20%. So there's going to be some skew coming in to the next month's wage numbers, which the Bank of England can sort of look through if they so wish, but the underlying numbers are still very hot. So there was a bit of an uplift, small uplift in expectations for cuts in terms of basis point pricing. June ticked up a little bit, August ticked up a little bit. I tend to think the other way, that those inflation numbers rule out or continue to rule out June. But it's all going to come down to the CPI data. The next CPI data is 22nd of May. Then the June numbers are the 19th of June. The June release is the 19th of June, with the Bank of England on the 20th. So they're going to get 2 CPI reports. So there's going to be a bit of a battle going on between some of this data that we're seeing in wages and what the inflation numbers say. So, yeah, I'm still very sceptical about them being able to cut in June. But then again, this is the Bank of England. If they want to do that, that's what they'll go ahead and do, irrespective of what I think. But certainly with wage data, it puts the pressure on them as well. BOE's Peel was out again speaking after that data, saying that the rate of pay growth remains quite well above what would be consistent for meeting the 2% inflation target sustainably. So he himself saying that those wage numbers aren't good for getting the targets or hitting the target for inflation. But then he did offer some hope to the Doves, saying that service inflation seemed to have peaked. That's one of the big areas of inflation they're looking at. He says that less restriction will be needed as persistence eases. So that's stickiness. That's their name for stickiness, persistence. So as that persistence eases, they'll look to cut. It says they can cut rates while leaving a restrictive stance, meaning that if they do start cutting, it's not going to be cut after cut after cut after cut. They can cut, sit back, and go with the data. It says it's not unreasonable to believe that over the summer we will see enough confidence to cut. Whether you want to call June over the summer or not is another question. Anyway, moving on. Fed's Jefferson says sometimes Fed communications can be misinterpreted, and the risk of confusion is high when officials speak but disagree. One could say that the risk of confusion is there anytime one of them speaks. But there you go. It says it's appropriate to keep policy rate restrictive until it's clear inflation is ebbing. And for now, it's important to look for more evidence that inflation is abating. Treasury Secretary Yellen has been speaking about FX again, saying that if intervention does happen, it should be for excess moves. And it's possible to intervene when excess volatility occurs. Intervention should be rare and communicated. So at the moment, the Bank of Japan and Ministry of Finance probably ticks enough boxes for her to get away with it. Says she watches the dollar, the euro, the yen, and the Chinese yuan, which may come as a bit of a surprise to Mr. Jordan at the SNB that the Swissy isn't on their on her watch list anyway. They usually pop up on the biannual intervention report that the Treasury issues. I think we've got one of those due soon if you've not had one out already. So we'll keep an eye on that. Now, the market got a little bit of a spook yesterday because the New York Fed one-year inflation expectations for April ticked up to 3.3% from 3% previously. So that follows on from what we saw in the Michigan data on Friday with those inflation expectations ticking up as well. The 3-year numbers from New York Fed showed inflation dropped a bit, though, to 2.8 from 2.9, but the 5-year inflation horizon saw it rise to 2.8% from 2.6%. This might be something that the market is going to perhaps want to hear Powell comment on, though he probably won't. It's not top tier data, this, but that's now two minor surveys, data points, if you like, that have shown 1-year inflation forecasts or expectations rising. One on its own is one thing. Two in quick succession becomes something else that may be commented on. We do have Powell speaking later today, 1400 GMT, in this moderated discussion with Klaus Knott over in the Netherlands. So we'll have to see what comes from that. That is all after the PPI data we're getting later today from the US as well. Just a bit of, we call it flow news or sentiment or whatever you want to call it. But Bank of America had their fund manager survey out, saying that those guys are the most bullish since November 2021. And they're being driven by optimism for rate cuts rather than earnings. 82% of fund managers expect the first Fed rate cut in the second half of the year. 78% say a recession is unlikely in the next 12 months. They also note that cash levels are down to a 3-year low of 4% AUM. That was down from 4.2%, and that the stock allocation levels are the highest since January 2022. So it shows you where money's going. It's coming out of cash and going into stocks. They say the survey, the global growth expectations have fallen though for the first time since November 2023. The fund managers are seeing a modest defensive rotation in May so far to staples from industrials. So a little bit of movement data from Bank of America there. Right, that's all I've got on the news front at the moment. K-Man's off till Thursday, so won't be getting any of his input. So I think the first thing to do is let's have a look at what's coming up from the PPI numbers. So PPI is expected to rise a pip to 2.2% year on year. Core PPE staying unchanged at 2.4%. The market will look at these month-on-month numbers as well for their influence for what that might transpire to into CPI. So PPI data, it can often be a bit more volatile than CPI data. So it's open to bigger swings because there's a lot of big price elements in that. You know, if the price of energy commodities move quite quickly, then they're reflected quite quickly and more broadly in PPI as well. So it's not like CPI where you know, a 1 pip, 2 pip variation might sound big. It's not in PPI. So look at maybe something like, I don't know, 3 to 5 pip changes before you start to think that things are moving a bit more significantly. So that's what we're looking at for PPI as well. Look through also some of the relevant components like the striped out, food, energy and transport to get a sort of core number. But anything hotter here than expected is going to get the market probably unwinding a bit of its cut expectations, shall we say, with Powell being so adamant that not to utter the word hike at all. That won't stop the market getting a bit more hawkish or less dovish if we keep seeing hot numbers coming here. So look for any upside numbers here to probably get the dollar shifting a bit higher again and yields probably ticking up as well. And then obviously after that, we head on to Powell. Right. Oh, we've got a few questions coming in already. Let's have a look what's going on. So, Ali, you've been journaling, analysing your mistakes in a trading journal. Yeah, that's a good thing to do. A lot of people do that. You've come to the conclusion trading is not that easy as we think. I'm surprised it's taken you that long to come to that conclusion. If it was that easy, we'd all be rich and famous. And you've got a question about trading entry. How is it justified when we say this is a risky trade or not a risky trade? The trade will go straight to profit target or straight to stop loss. Trade, how to define a trade is risky or not? Well, let's put it in simple terms, okay? If you want to trade a level right now, this minute, it's not very risky because markets aren't moving very much. It's a bit quiet. We've got tight ranges. You know, there's what, a 19 pip range in euro dollar. So trading is not very risky at the moment. That doesn't mean you should change your lot size or anything like that. But because if you do get a big move, then you're likely to be knocked out. Obviously, trading 5 minutes before a big event like an FOMC or an FP is risky because of the event risk. So that's something to take care of. It's also other factors, you know, like trading the yen at the moment is risky because there's higher volatility because of that intervention risk. But generally, your risk should be pretty much the same depending on your trade style. Like you like to risk, you know, 20, 30 pips for 20, 30, 40 pips profit. So your risk, if you're doing that 5-6 times a day, then you shouldn't be trading more than 1% or risking more than 1% of your account on any of those trades. You should probably be doing something closer to 0.5% on trade. So your risk is also determined by your strategy. If you're a short-term intraday player, then you should be looking at lower risk and just sort of sniping for those 10, 20, 30 pip trades. You don't want to be risking a lot on that. But then when I trade longer term, I can go higher risk, and I'm happy to go higher risk because my trades long term are not overly affected by the intraday noise. So it doesn't bother me if a data point comes out and the price moves 50 pips, 100 pips. It's not going to define my whole long-term strategy if I'm trading over, say, a 500 pip range. It doesn't matter what the intraday noise does. So, and because I'm going longer and slower, I've got time to adjust strategy. So I'll go in with small entries and build up my risk. It won't be day one risk 5% in the first trade of a long-term play. So I may come in with lots of little entries and just build the risk up slowly. But trading isn't easy. You always find you lose money quicker than you make money. So if you get a trade wrong, it's going to go wrong quicker than a trade that goes right. That's a psychological battle we have to face. And that can also tell you that perhaps you need to look at what you're trying to trade. Are you trading the I think, or are you trading the price action? Because if you're trading the I think, your mind I think doesn't matter, doesn't come into it. We don't trade I think, we trade what the market does. So if you think the price is going up, justify why it's going up, and don't just justify it because of I think. Justify it of what the market's doing. At the moment, you can take let's look at cable, for example. Just in the short term, just in the very short term, we've had this move from the one near 129s. It's come all the way down to 123s, and now it's creeping higher. So all through this phase, you're probably going to be not doing well on the long side, trying to buy the dips. You can hit the levels. Yeah, you might get a good move, but the general trend has been down. So if you identify that this general trend is down, then you know that if you want to fight that, you might want to do it with less risk because you're fighting against the wind. You're fighting the market. So if you're going to fight the market, and the market that's got bigger pockets than you, then don't put so much on the table. Fight with smaller amounts. Conversely, on this side, we're now in a very short-term uptrend. Okay, so now this has stopped, and now we're going this way. So shorts, are probably the harder trade depending on your strategy. So that's how you also assign your risk. If you're fighting the market, go with lower risk or smaller risk, because if you get caught out, you're not going to lose too much. But then you can increase your risk if you're going with the flow. Again, not excessively, but if you're going, let's say you're trying to buy into this downtrend, then maybe go with 0.25% risk. But if you're shorting it within the downtrend, you can go 0.5% risk. So you take the market as it is, and then similarly, you get periods of consolidation where it just goes sideways, and all you want to do is sit at the top and bottom of the range. Again, you keep your risk fairly low, and you just look to keep doing a zigzag. Sell at the top, buy at the bottom, sell at the top, buy at the bottom, and just play the range. So it's all about assessing where the market is, what the market's doing. Right now, the market is looking for any excuse to whack the dollar. Any little bit of bad news, and it wants to hit the dollar more so than buy a dollar on good news. So if you're trading long dollars, you've got to be more careful, because one data point miss is going to hurt you more than one data point beat gives you profit. So again, that's how you assign your risk. You think, right, well, if the market's doing this and I want to fight the market, I'm not going to do it with as much money on the table. So that's how you go about assigning your risk. You have to take the trade, the conditions, lots of things into account before you decide how much do you want to, put on the table. So yeah, that's my view on that one. So anyone else got any questions or input on that, please feel free to put it up in the chat there. So while we're on cable, so this has been given a little bit of a knock on the head. We've hit this it's very short term resistance point. It was something we had before that spike up early in May. We had a bit of a level around this 125, 60, 70 area. As you can see there, just in there, we had a little nudge there before we got this spike move, and then we came down below, then we mooched around, then we found it resistance again, resistance again, resistance again, and then yesterday we found it resistance again, and then we just keep bumping our head up here in the 60s, 70s. Now the market has taken that data a little bit bearishly this morning, the jobs data, and then Peel's added to that as well. So that's knocked it down towards this 125 zone. I was maybe thinking about having a little buy down here to my longs. I'm long from this one after over the BOE from last week down in the 124.50s. So I've been chopping this all the way up to these levels here. I do think about maybe having another little nibble, but again, you want to talk about risk, Ali. I don't fancy just getting in a bit more trade to sit and do nothing while we wait for this data and power to pop up. I don't want to get stuck in a rut, going sideways and doing nothing. So I'm just going to keep the long I've got because it's got a bit of margin in it, and I can just play with that margin over the data and whatnot. But otherwise, you know, we've had this move down, we've had this move up, but as you can see, we're doing a bit of sideways at the moment. So it looks like we're going to be ranging for a bit for want of waiting for these data points to drop. So yeah, the PPI could be a decider. It will take this one way or another. I still favour selling dollar strength. So a hot number on this one, if we get maybe down to that 124.50, then I'll look to add back to my longs, depending on how big a variation the data is. But we've got to trust Powell, and he's saying hikes aren't coming, so anything that the market takes as hawkish might end up getting reversed again on Powell later on. Euro sterling, again, following the pound weakness, we had another little look above, 86.10, couldn't quite get up to the 86.20s again, which is sort of the main level here at the moment. So we've eased off a bit there. Still, it's not looking overly strong. While we're holding above 85, 70, 80, then it's just keeping its head above the water. But if we get back below 70, then we're probably going to be back into playing this range down to the low 85s again. But we're keeping it up here a little bit, but we need to get through that 86.20 and then take on that zone above 86.45 to 70, the age-old zone up there. So lots to be done with that. Now, one of the reasons why the dollar selling that we saw for a lot of yesterday saw the brakes slammed on was that New York Fed CPI data that came out late in the afternoon. That did for dollar yen through 156. We've been banging ahead on it all day yesterday, 155, 80s, 90s. And then that data came out, and this one doesn't need much in the way of a green light to keep rallying higher. So that broke through 156, and now we're probably going to be looking up towards 157, which was a bit of an old level as well. 155 is the bigger support, I think, building below 156. We'll need to see if that is going to support as well, which it should do, given how much it was resistance beforehand. So I'm expecting that to be support if we get down there. Probably some short-term stops, maybe through 85, 90, if we see a move back under. But this is still a bit volatile. Volatility is up 9% still for this one. And the higher we go, the greater the intervention talk will start ramping up again. And will they, won't they, will they, won't they? So playing the same old games here. I'm still loath to touch it. I may, as I said before, give it a go if we get up to this 160 area, which is more of a longer term technical area than anything else going on. As you can see, that 160 area going all the way back to the 1990s and beyond. So that's why that level is a big old level. And no surprise that we pretty much stopped on a dime there when we were up there last time. So that's technically, that's about the only level I'm going to look to lean on myself. Dollar CAD, doing a bit of mooching as well. Still holding above this 136.50, finding a bit of support about 10 pips above, but doesn't look like it wants to move higher. So this is another one going sideways a bit. We keep getting similar price action. You know, we get a move up to that high 137s, 138s, then we tend to have a little reaction down, then we sort of build again, go again, and down. So, you know, it's a bit of a pattern here of consolidation going on, but you can see that dips are well received, and people like to buy into those. So yeah, that 136.50 is going to be a consideration again. Depending on the data, this again might be another one that I look to take along down towards that 136 area as well, but just more from a technical point of view rather than a bias point of view. I'll keep looking at all dollar pairs at the moment. Aussie dollar, another one doing a bit of consolidating, trying to keep its nose above this 66 handle. But as you can see, we have been respecting that 65.80 again. We had a breakdown. It's been quite an important level, you know, if just for the short term and a bit longer as well. So it was decent resistance. We had the break, held a support, got a break, then it's held again. And so, you know, it's becoming a bit of a pivot level. So while we're above that, it keeps the upside momentum in play, but below it, things start to look a bit weaker, although we do have this secondary support point around 65.60s. Aussie Kiwi is one also I'm keeping an eye on, maybe for a bit of a break play. We had this 110, 15, 20 area. It's going a bit longer. As you can see, we've had a few goes at it, but couldn't hold a break above it. And, you know, we've got quite a strong trend here. It looks like quite a decent trend. You know, we had this move up, bit of a refresh, now move up, hit that area early May. Now we've just come off, but we're not dipping too far. So it might suggest that we're looking potentially for a break above there. And if we do that, then I'm maybe looking at trying some buy stops just above the level there, or wait for a confirmation hold before seeing if this one wants to push higher. We've got a bit of difference between the RBA and the RBNZ, with the RBNZ maybe looking a bit more closer to rate cuts than the RBA, data permitting, of course. So that might be a reason why this one goes. Plus, as mentioned, if China are going to start getting themselves off the floor, injecting some more cash, easing, then that might be a little bit of a pick-me-up for the Aussie as well on the risk front, economic front as well from China. Going to look at what should we look at next? And feel free to give me something in the chat if you want me to look at something in particular, rather than me just waffling on. It's a bit hard to try and take any inspiration from these markets at the moment. As you can see, gold still just doing its sideways thing. Now, as much as this isn't conducive to my sort of trading, these quiet markets, it does let us know where the ranges are, though. So we've still got called it 2260s, 2360s as a bit of a sort of inside range ahead of the 2400 and 2220s. So if you want to be scalping around, you've got a few levels you can lean on here, but it's not doing an awful lot at the moment. Oil markets as well. We've had this move down, and it's not really bouncing too much. $80 seems to be a bit of a ceiling at the moment, so it's keeping a bit of bearish pressure in, but it's still holding this uptrend while it stays above this 50 fib. We did have a little knock below, but then it's retaken it and it's starting to hold it again. So this could be just a little bit of a refresher, and then we're going to head much higher. But if if we get under here again, this 50 fib, and it starts to hold, then we're probably going to be looking to unwind a bit more of this rally that we've seen since latter part of this year. Yields are going to be something we need to keep an eye on for the data. 2 years obviously still important. As you can see, we're knocking our head on the let's call it the 2-cut line. So the market in terms of 2-year yields just feeling a little less hawkish still at the moment. We're still well above the expected 3-cut line. I would be very surprised if we get to the next FOMC and they keep their 3-cut medium there. I would expect that to be coming up in the next dot plot if the data is still where it is, roundabouts where it is at the moment. And if that's the case, once again, that might turn the market a little bit more hawkish because, you know, the Fed themselves are now winding down the amount of cuts that they saw coming. If it goes to 2 cuts, the market will be thinking, well, when's it going to go to 1 cut? But we're all data dependent, as we've been saying for quite some time. Stocks, S&P has, well, again, it's hit its head up here. This is an old level. It's only a short-term level. So it's not much of one, but it's shown up previously and it's showing up again up at 52.40s. We're finding a bit of support down below coming into the low 52s, but it's just a little bit messy and untidy. So it's definitely not breaking this trend at the moment. But this was a recovery off of that. It's amazing how people are talking now. Everyone's, yes, this is going to new all-time highs. When we were coming down, everyone was trying to pick a top up here, and then it was going to 4,800 when we were in this move, and now everyone's swung around again and we're going to all-time highs. That just tells you not to pay too much attention to some commentators in the market. Obviously, not those who are not from ForexAnalytix. You can listen to those guys all day long. They're pretty good, actually. But yeah, this at the moment is still looking like just a trend refresh. You know, we had a fairly decent move, and all trends need a good refresh. And this is looking like one of those. So yeah, I wouldn't be surprised if we do go on to new highs. But what we do up here will be the decider. If we bang our head on any of these highs up here, 52.60s up to 80s. If we head ahead there again, then there's a very good chance we see a decent double top put in play, and then maybe we get a bit more of a move back down. But, you know, you can't keep a good stock market down, as we know, over the past, 10, 15, I mean, you want to call it 15 years. You know, that's a trend that isn't changing yet, irrespective of these little blips that we get in the middle. So, nothing here that suggests that this trend is changing at all, but you get these refresh moments. This might be another one here as well. UK stocks, going to have a quick look at that. Not often you see this one above 8,000, and it's really starting to motor on as well. Quite a significant move considering what's going on, but it does show that, I don't know if it's the easing bias that's coming from central banks, that the market's thinking, yeah, lower rates, we can borrow cheaply and chuck it in stocks. You know, the economies are doing okay. You know, UK, Europe, you wouldn't call us booming at the moment. Still producing 0 point, this, that, and the other growth numbers. So it's not really an economic background. You think, yeah, let's pile into companies, but market's going to do what market's going to do. Unless we see a real turnaround in growth, then maybe this is going to continue. And you know, we're seeing the likes of the DAX as well. You know, look how crappy the German economy is, yet its stock market keeps going higher. So it's still all very disjointed. It just still doesn't compute in my mind why you see a stock market rallying so much when the economy isn't doing as good. But that's been the case since the GFC. So can't fight it, got to go with it. That's the way to look at it. Devesh looked at gold already. Sugar, Frederick. I couldn't tell you last time I looked at a sugar chart, mate. Let's have a look. I wouldn't even know where to look at. Let's go with sugar. Well, let's just grab that one. There we go. First one on the bat. Right, what to make of this one then? And please feel free to give me your opinion as well, Frederick. What exactly do you want me to look at with this one? Quite a steep downtrend, which, I don't know, we've seen a lot of movement in commodities at the moment. And yeah, some going one way, some going the other way. This one obviously looks like it's looking very, very weak. You're probably looking at, if you're looking at main numbers down around this low 17s, you're probably going to find a bit of support down around there. But we're certainly undoing all of this. This sort of thing may be a factor that plays into you know, the inflation picture as well. You know, we've seen cocoa and commodities like that shooting to big highs, and then they're coming off quite a bit as well. So, you know, there's going to be some impact there. But yeah, 17's probably level, give or take. Maybe some support coming in 17.5. And we've broken this low around the 20s. It's already just trying to hold as resistance. So that's going to be your top side level to watch back above there. And then maybe we're going to move back up a bit as well. Angela, don't talk to me about cup and handles. The only cup and handle I'm interested in is the one that holds my cup of tea, which I like half a sugar in. So yeah, you won't find me propping up sugar markets. I don't like don't like a lot of sugar in my tea or coffee. So yeah, I won't doing sugar any good at all. Right, well, not a lot else to talk about. So unless you guys and girls have got anything specific you want me to have a mooch about, yeah, I might do that. Alex, go and make myself another cup of tea. Well, we'll call it a day, I think, then. Big events to come, obviously. PPI, POW. So if nothing's going on in the meanwhile, do a bit of chart homework, know your levels, look at where you'd want to trade if you get a big move. Don't get too stuck into the numbers either. You know, I've seen a few people just who traded the UK data this morning were, you know, expecting the pound to do something significant, and really it's only moved 20-30 pips. So don't get too overexcited about where the market may go. Look to the extremes. Look at if the market moves too far from what the data says, and then maybe you can look at a bit of a counter trade. But other than that, trade well, be safe, and we'll see you all tomorrow. Have a good one.